it may very well be that we have seen the bottom of this shakeout, this after halving minor shakeout in June, because July already had a higher minor revenue than June. So what we also see is that difficulty, so the hash rate basically jumped today with plus 10%. And that indicates that the old miners, the old and small miners indeed left the market. And we'll see rising hash rates, which is good for Bitcoin security, and rising prices into the future.
Anonymous Bitcoin analyst and creator of the Bitcoin stock-to-flow model, PlanB, has introduced a new chart focusing on miner revenue. This chart offers a detailed analysis of miner revenue over time, tracking how much revenue miners earn at different points of the Bitcoin halving cycle and how fluctuations in their revenue can impact Bitcoin prices. The former institutional investor and quant analyst unveiled the chart in a tweet on July 29, along with his prediction for Bitcoin based on recent changes in miner revenue. The tweet, which has garnered over 10,000 likes on X, reads, "Miner revenue bottomed after April 2024 halving. I expect Bitcoin's price to double from today in 3 to 5 months." In follow-up tweets, PlanB clarifies that he anticipates Bitcoin to be trading around $140,000 per coin by year-end, aligning with his stock-to-flow prediction of $150,000 per Bitcoin by the end of 2024. Additionally, PlanB asserts that $140,000 will not be the peak for this cycle, predicting that Bitcoin's price will climb even higher in 2025. Another tweet states, "I don't agree with a $140,000 top and diminishing returns. In my opinion, Bitcoin will average approximately $500,000 between 2024 and 2028, as per the stock-to-flow model." In a recently uploaded video on his YouTube channel, PlanB delves deeper into the miner revenue chart and his expectations for Bitcoin's price in the coming months. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Here, it's Bitcoin miner revenue, and it's very interesting at the moment. So what we see is the blocks on the x-axis. Every 210,000 blocks, we have a halving. So there's a block every 10 minutes. 210,000 10-minute periods is 4 years. So every 4 years, there is a halving. We just had one in April. And what happens at a halving is that miners' revenue halves as well, because they mine the new Bitcoins. And this is only new Bitcoins, by the way. It's not the fees, which is a small part of their revenue. So it's the new Bitcoins that they mint. But after a halving, they get half of those new Bitcoins, and their revenue drops overnight, which is horrible for any business to be in. And they have to recover from that. So usually what happens is that the small miners that have old equipment, inefficient equipment, uses a lot of electricity, and also that have high electricity prices, they can't mine at a profit anymore, so they drop out. They just quit. They're running at a loss, so they have to quit. And the new miners, the miners with new equipment, the latest and greatest in hardware, very efficient and lowest prices, maybe free energy prices, those are the ones that can still produce at a profit. Those will survive. So this shakeout, every halving is a very important event, a Bitcoin-specific structural event that happens every 4 years. And the entire Bitcoin market, Bitcoin itself, has to survive that shakeout. And we're in the middle of that right now. It's always very volatile. Hash rate drops. Everybody's talking about miner capitulation and that the miners will just quit, which never happened, by the way. It's just FUD. But what's important is that this industry is growing a lot. So in the beginning, a monthly revenue was only about $1 million for all the miners in the world. Right now, we're talking over $1 billion every month in revenue for Bitcoin miners. And at the peak, it was $2 billion. So that halved to just under $1 billion. And what we see now is very interesting. The only way for miners to recover, for mining revenue to recover, which it always did, is for Bitcoin price to double. So the number of new Bitcoins in a block halved. So the price has to double to keep the mining revenue the same.
Let us know your thoughts on PlanB's latest reveal and his updated predictions for Bitcoin by year-end. In other news, reports from various sources indicate that over $2 trillion were wiped from the stock markets on Friday due to fears of a global recession. This significant loss marks the worst on record since the peak of the COVID-19 crash in April 2020. The crash was triggered by the July jobs report released by the Bureau of Labor Statistics, which showed a substantial slowdown in hiring. The U.S. economy added only 114,000 jobs in July, a sharp decline from the average of 215,000 jobs added monthly over the past year and far below economists' expectations of 175,000 new jobs. The BLS also reported that unemployment rose to 4.3% in July, its highest point since October 2021. The sharp decline in job listings suggests that the U.S. economy may not be as strong as anticipated and could be heading for a recession. Investors are now expecting more aggressive Fed rate cuts to combat inflation and strengthen the economy, especially as the November elections approach. In the latest episode of Her in the Know podcast, ARK Invest founder, CEO, and CIO Cathie Wood discusses the stock market correction, the Fed's next steps, and what it could mean for the U.S. economy in the coming months and years. According to the renowned fund manager, the U.S. economy is heading for an all-at-once moment and is already deep in recession. Here are some clips from the video.
The markets are moving very, very rapidly, as I'm sure you've noticed. The stock market's correcting quite significantly, the correction we've seen in the last week. Bond yields are falling fairly dramatically. Commodity prices are falling and in some cases breaking down. Yield spread, so the spread between high yield bond rates and treasury bonds, that spread is starting to gap out. So the fear is seeping into the markets in many ways and in many indicators. And we do have a point of view, and so I'd like to introduce it. You've heard it here before if you've been listening, but for those who haven't, I'm going to say this is slowly, then all at once. So we have been talking about the rolling recession that has been in place actually since the Fed started raising rates in 22. As soon as the Fed started raising rates, housing effectively went into a recession. Commercial real estate office was already in a recession. Now, multifamily real estate seems to be an issue now. We've seen autos stall out. They've kind of stabilized but stalled out at subpar, meaning subnormal expansion rates. We're seeing capital spending come down. We're seeing consumer confidence relapse. Housing was starting to pick up its head and has relapsed again, certainly if you're looking at sales. So we've had a rolling recession, and now we seem to be in the all-at-once phase. Many people are beginning to understand, we think, that perhaps the idea that inflation is the problem has been misplaced. And this rolling recession is going to end with pricing coming down. So I've been saying the risk is deflation, prices coming down, and listening to Amazon's report last night, it's clear the consumer wants lower prices and is getting lower prices. The consumer is not falling apart yet. It's actually responding to some of the lower prices, even in autos. But nonetheless, falling prices, which is a problem for companies, it means their margins are going to compress. So the all at once has to do with deflationary signals. Now, this week we got the PMI, Purchasing Managers Index, and today the employment report. Both of those are recessionary. So this idea of we're in a recession is beginning to gain more traction. And in fact, the SOM rule in the unemployment report, basically the unemployment rate going up by 50 basis points as measured on a 3-month moving average basis relative to its low, that triggered. And so a lot more people are now thinking recession. Now, we're not thinking at all, when we say all at once, anything like 08, 09. In fact, the rolling recession part of this scenario would argue against that. So we're not at all suggesting that, but we are suggesting that this focus now on pricing power is going to be significant.
Like Cathie Wood, Real Vision founder and CEO Raoul Pal believes the Fed should be cutting rates already. However, in one of his latest tweets, Pal suggests that the Fed will maintain a hawkish stance for longer to facilitate more aggressive rate cuts in 2025. The longer the Fed drags things out, Pal began in his tweet, the better chance the Treasury has at refinancing debts closer to 2% in 2025. This is the entire game: refinance debts below the trend rate of nominal GDP and fund it via liquidity. Forward-looking inflation is already less than 2%. Pal has previously noted that the Fed uses lagging indicators, which is why rate hikes didn't begin until inflation hit multi-decade highs in 2022 and why rate cuts haven't started despite indications they do. Pal believes the Fed's mandate is more about refinancing debts at the lowest rate possible than controlling inflation or mitigating the economic pain caused by its policies. As a result, the Fed has prolonged its hawkish stance to justify aggressive rate cuts in 2025. In an earlier Twitter thread, Pal provided an update on the state of the markets, particularly the cryptocurrency market, which he says has now fully transitioned to macro summer. He shared several insights. Macro summer is beginning to take hold and should last at least for the rest of 2024 and into 2025. 2-year yields have formed a large top with a potential objective to 2.5%. Bitcoin is ready to soon break the giant cup and handle and head into the banana zone. Gold should see its next leg higher soon too. Inflation is slowing down sharply. The final thing that would ease financial conditions further would be a weaker dollar, which I think is likely. This confluence of events may take a little more time to play out or could happen with the FOMC. Who knows? But good times lie ahead. Enjoy macro summer. Pal is certain that with the Fed rate cut now imminent, rising geopolitical tensions in the Middle East, and other triggers, especially a Bank of Japan intervention to strengthen the yen, the rest of the year will be very favorable for cryptocurrencies and other digital assets. Do you agree? Please share your thoughts on PlanB's, Cathie Wood's, and Raoul Pal's analyses of the cryptocurrency market, the U.S. economy, and the impending Fed rate cut in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.